Hello and welcome to another edition of 9 to 5 Live. My name is Mark Williams and joining me is Francois Savary. Francois, hello.
Hello, Mark.
Good to see you again. Thank you for joining us. I want to turn to the market that's looking remarkably risk-off just in the past week, despite yesterday's rally. The jobs numbers have really spooked the market. The market is looking for 0.5%. They're really pushing for 0.5% cut in interest rates by the Fed middle of this month. But do the data that would justify a 0.5% cut, is that making the markets reflect on whether they still want to be invested in this market or not? Before I come to that, just quickly, data out from China this morning, export data, they were stonking numbers. Is that good for us or not? I don't know. The exports were up 9% in US dollars, slightly less in yuan, but they were up 13% to the EU. What does this say about, what is the effect on our economy, first of all, potentially? Do we have any data on whether the increase in exports is down to dumping in terms of pricing, or whether it's just things are going better?
I think that you have clearly, there are numbers that were published yesterday that you need to put into context with what we had today about the trade balance. First of all, you mentioned the fact that exports are going up more than expected, but what is very interesting to me is the fact that imports were lower than exported. And yesterday we had some numbers concerning inflation, CPI and PPI, and they tend to point towards more deflationary risk in China. And I think this is not something that is very positive. To answer your question about the fact that is it a question of volumes, is it a question of dumping by the Chinese by cutting prices, the fact that PPI numbers were lower than expected yesterday, falling down by 1.8%, tells you really that there could be an argument to say that they are dumping the prices to try to export as much as possible. And why do they want to do that? Is because they have huge problem internally. Investment and consumption are on the downside. So it means that they need to support the economic activity through the trade balance. And that's something that the US and European are not necessarily going to like.
Coming to the Fed now. The yield curve has come back to its normal position ever so slightly. People like Joseph Stiglitz are saying the Fed is behind the curve. He said the Fed they increased rates by too much and too fast, and now they need to make deep cuts to interest rates. Is the yield curve confirming that? How sustainable is this normalization of the yield curve? And what does that say to you anyway?
Okay, is it sustainable? I would tend to say yes. I would tend to tell you that clearly the declaration of the Fed, the Jackson Hole speech and everything, and I don't remember, but on Friday it was Mr. Waller, I think, that spoke, and it in a bit spooked the market, because by speaking too much about 50 basis points, you reinforce the fears that there is a recession looming, and this was also one of the reasons on Friday the market finished so badly the day, not only because of the employment number, but getting back to your question, yes, it is sustainable because the US is entering a cycle of monetary easing. The big discussion and what is dividing the market is, will it be quick? Do they do an insurance cut by cutting 50 in September on the 18th, or are they going to go slowly and continue with a strategy that is data dependent and observe how the labor market is moving forward in the coming months? I still think that it is a close call. I do not believe that they need to do 50 basis points right now. They can go by 25, go three cuts of 25 basis points by the end of the year, and continue to lower rates by next year. It is a huge discussion. This is what, in a way, is animating the market right now. This discussion, they are too late. Discussion, no, they can go step by step. And this is the reason why you have this risk-off mood on the market. You also have something that you need to keep in mind, the US election. And tonight we have a big event with the debate between Kamala Harris and Donald Trump, knowing that Donald Trump is getting back into the polls after being behind. Kamala Harris is coming back. So there are different elements that explain this risk-off mood.
The markets are really praying for a 0.5% cut, or certain numbers of them are. But the market's been terribly scooped by the job numbers. Now, do the data that would justify a 0.5% cut, is that why the market is risk off? If, for instance, the market did get a 0.5% cut, would that really lead to a rally of, say, a few days or a few weeks anyway?
I'm not sure. That's the reason why I tend to believe if you are the Fed, you don't want to give a negative signal about the economy by cutting by 50 basis points. Or you will need to have a justification that is going to be very, very clear, saying it's not because the economy is going to a recession, it's because we want to act with an insurance cut. And it's a very, very tricky one. I am not sure that the market is going to particularly like the 50 basis points. No, I don't think so. What the market like, and we need to keep that in mind looking backwards over the last few quarters, is the soft landing scenario. And I think this is what the people want to see. I think that's what the market wants to see, because soft landing means earnings are going to stay on the good side of the ladder. And that's something that is very important in terms of expectation.
Let's turn to the ECB now, who are making their rates decision this week. They didn't wait for the Fed a few months ago to start their first cut in this new cycle. Do you think the ECB will wait for the Fed to see? Presumably, they think the Fed will cut. Will they wait for the Fed to see by how much they will cut before they make their move, or will they cut this week?
I hope they will not wait for the Fed, because I think that in Europe you have all the necessary number to justify a rate cut. I hope that they will cut for a second time this week, and that they will continue to cut in the coming months. I think all the economic number, the growth number, are pointing towards something that is a stalled economy, and inflation is getting towards the objective. So I think, and there was also something that came out over the last few weeks, is the number concerning the wage growth. Salary growth is slowing down. This was one of the main elements for the ECB to be very cautious in initiating the process of rate cuts. They have all the reason with the salaries growth coming down. They have all the reason to act this week on rates, to my point of view, with a 25 basis cut.
The markets are waiting for, apart from other things, CPI and PPI this week. Obviously, the market's going to be watching that like a hawk. How much room is there for disappointment in those numbers, do you think, or they are expected to be down from previous months? Is that how you're expecting them?
I hope that the number are going to confirm the trend. It's going to be very important for the Fed message next week. It's going to be very important for justifying the move that they are going to do, to my point of view. It would be very, very bad if the number come higher than expected, or that because the market would then reassess. And again, it would be something that is not necessarily positive. It would be, okay, the Fed does not have the room to cut rates, and it could create some volatility on the bond market, something that the equity market is not going to like in the current conditions.
Some commentators are calling for a sharp drop in the dollar. Is this something that concerns you? And if you see it going down, to what extent do you see the dollar going down against, for instance, the euro?
I would say that I am not too worried. I think that the trend for the US dollar should be down against the euro, for example, in the medium term. Does it mean that I see the dollar going to 120, 130 and those kind of level? No, I don't think so. Because even if the US economy is slowing down, it's still in better shape than the European economy. Nevertheless, there is something that we need to keep in mind, is the fact that the debt situation of the US is deteriorating quite significantly. And when you look at economic program for the medium term, especially the one by Trump, and how it will add to the public debt in the US, this is something that is worrying for the US dollar. This is it's not something that is a hazard that suddenly Mr. Trump is speaking about imposing tariff of 100% on currency that on a country that decide not to use the dollar anymore. It's because there is a real threat. The IMF, everybody is aware that it's the public debt in the US is not on a sustainable path for the medium term. That's something that could weigh on the US dollar. But short term, 115 to my point of view is something that is a maximum for the US dollar in the next 3 to 6 months.
Lastly, let's talk about portfolio positioning. The Philly Semi Conductor Index is down 25% in the last few months. And in that same period, the S&P Equally Weighted Index is up a few percent.
Mm-hmm.
How should we be positioning our portfolio before this potential big rate cut by the Fed in a couple of weeks?
Usually, if you consider the history of rate cuts, and let's say that we avoid a recession. Let's say, because this is not the scenario that I defend, and I defend that we are going to get into a soft landing, so you have some experience of what happened in this case. What is clear, we discussed that over the last few months. We were discussing the fact, do we want to increase technology or not, and etc. I said, you need to diversify into defensive sector. And I still believe that visibility is something that is very important in the coming quarters in terms of positioning. More defensive because because of the performance of those sectors, they are very exposed to technology, and so they can keep the stock they like, but they need to diversify their portfolio into defensive, stable growth. Healthcare is a candidate that is very interesting to my point of view, not a very expensive sector. So this is the kind of mood I would recommend in terms of positioning for a rate cycle in the US for the coming 18 months.
Thank you very much, Francois. I think we've been all the way around to the roundabout. I'll speak to you hopefully next Monday.
Okay. You have a good week.
You too. Merci, Francois. Au revoir.
Bye bye.